Well, hello and welcome to another of our topical tax tips. My name's Bernard Critchey and I'm the tax manager here at Aspen Waite in Bridgewater. Thanks again for all your comments that have been coming through. You keep those coming. And also, if you'd like and subscribe to the channel, you can see from the details below, and that would really help us continue to grow our profile. Thank you. Today I'd like to talk about family investment companies, which may help anyone who is holding substantial investments and may be subject to higher or additional income tax rates to enable them to handle their investments more efficiently. So what's a family investment company? Well, broadly it's just like a normal company, but unlike a trading company, it is used for investment purposes. You'll still have share capital, but the company invests instead of trading in such things as properties, cash, or shares in a portfolio. So a family investment company is set up by the founders, no specific number involved there. They will transfer cash or assets, usually by way of a loan, or sometimes by using the CGT incorporation relief that could be available. There's some substantial tax savings, as the FIC, because that's what I'm going to call it from now on. The FIC pays tax at the corporation tax rate rather than being taxed at the higher rates that personal income tax or capital gains would have. If you're putting property rather than cash into an FIC, this could trigger a capital gains tax charge and also a stamp duty land tax charge, which may in certain circumstances be reduced by the availability of any reliefs. And if that's a particular thing that you'd be interested in finding out more about, I'd be happy to help anyone on an individual basis. Setup costs and ongoing administration costs for corporation tax and accounts can make it more expensive to operate through an FIC. And the FIC may not be the correct structure if you want to extract the profits that the company makes in a short period of time. So how is it set up? Well, it's usually done by the founding shareholders, as I said, and they will be transferring the assets into the company in exchange for shares. They will maintain control over the company and therefore they'll be able to continue to control the payment of dividends and the return of any capital. This is normally done by separating the rights relating to the shares within the Articles of Association and also a shareholders agreement. When the FIC is created, family members can be brought in as shareholders. Different classes of shares can be issued. As I mentioned, corporation tax rates are lower than income tax rates, and any assets sold are also taxed at the lower corporation tax rates rather than the personal capital gains tax rates. But 2 points to mention regarding share portfolios and residential property investments. Under the current tax system, there's no corporation tax at all on share portfolio dividends, and so any income received by the FIC would be tax-free. There's no limit on the investment, so it may be a useful alternative to ISAs, which has the annual limit on investment. A residential property portfolio held by an FIC would allow rental profits to be taxed at a lower rate, as well as getting full deduction for loan interest, which is restricted to basic rate relief for individuals. The company wrapper of an FIC shelters investments from income tax until the funds are extracted to the shareholders, and this is usually done by dividends, and they're taxed at favourable income tax rates. And we've discussed the payment of dividends in a previous session. Dividends paid to minors, however, would be taxed on their parents in most circumstances. However, for children that reach the age of 18, a payment of a dividend up to the basic rate band can be a very effective way of extracting funds to provide cash to help with things like university fees. As you can see, the FICs should be used as a long-term strategy, not a short-term strategy. You'll gain the most benefit from an FIC when the capital and income is retained within the company for long periods and can then pass wealth on to the next and subsequent generations. Transfer of shares from one generation to the next is a pet for inheritance tax. We've discussed this in previous sessions. And unlike a settlement into a discretionary trust, and therefore, unlike a settlement into a discretionary trust, it is exempt from inheritance tax, provided you survive the gift by 7 years. So in conclusion, a family investment company can be used as an alternative to a family trust. It can enable parents or grandparents to retain control over the assets while accumulating and passing on wealth in a tax-efficient manner to future generations. It's not for everybody, as founding shareholders would be giving up the immediate receipt of income, so it would only really benefit those with surplus assets, surplus investments, or those who are not requiring the income to maintain their current lifestyle. I hope you've enjoyed today's session. If you've got any comments, then please use the comments box below. If you've got any thoughts about future topics that we could discuss, then please also use the comments box for that. If you want to get in touch with us on any particular issue that I've either discussed today or previously, then you can come and join us at, there's the website detail, it's www.aspenwaite.co.uk, and we'll pick up your query and get back to you as soon as we can. So until the next time, thanks ever so much for tuning in, and I hope to see you all again soon.